Hi, welcome to this presentation, Annuities 101. My name is Patricia Dorn, and I'm with the Consumer Education and Advocacy Unit of the Maryland Insurance Administration. My email address is at the bottom. It's patricia.dorn@maryland.gov. So if you have any questions, you can email me at any point. So what is the Maryland Insurance Administration? So who are we as an agency and what do we do? The Maryland Insurance Administration, MIA, we're the state agency that regulates insurance in Maryland. And that means that we license the insurers and we license the insurance producers. The insurance producers, those are your agents and your brokers. So we license the insurers to do business in Maryland, as well as the agents and the brokers. We examine the business practices of licensees to ensure compliance. So we make sure that they're following Maryland laws. We monitor the solvency of insurers. And so we're making sure that the insurers that do business in Maryland have the money to pay claims. We review and approve the insurance policy forms, and we review the insurance rates to ensure that the rates are not inadequate, so they are collecting enough money to pay claims, but that they're also not excessive or unfairly discriminatory. And we investigate consumer and provider complaints, and we investigate allegations of insurance fraud. So what is an annuity? An annuity is a contract between you and an insurance company under which you make either a lump sum payment or a series of payments. And in exchange for those payments, the insurance company agrees to make payment to you in the future. The amount of this payment is determined according to the terms of the contract and the market environment. So it typically varies depending upon the amount of the original payment, the length of the investment, and any withdrawals you may have taken, as well as other factors. Although annuities are not life insurance, most include death benefits. Annuities are frequently used as an investment tool. However, they may not be the best investment option for you. So, tips for understanding annuities. An annuity can have a number of features, requirements, and options. So, the details can be difficult to understand, even for an experienced investor. And it is strongly recommended you consult with a trusted advisor when considering an annuity. You can gain a better understanding of an annuity by knowing the answers to these questions. And I'm going to go over these in later slides. So, how does the annuity earn interest? Is it fixed or variable? How do you pay premiums into the annuity fund? When does the annuity start paying you? How does the annuity pay you? And what administrative fees and charges does the annuity have? Is there a surrender fee? And so getting the answers to these questions can provide an overall sense of the annuity's main characteristics. So how does the annuity earn interest? The first question, is it fixed or variable? So there's two basic types of annuities, fixed and variable. In a fixed annuity, the insurance company guarantees that you will earn a minimum rate of interest during the time your account is growing. So the interest rate may fluctuate. Fixed annuities tend to be more conservative, and the guaranteed rate may be higher or lower than the interest rate you would earn in a bank savings account. An equity index or fixed indexed annuity is a variation of the fixed annuity. In an indexed annuity, you choose how you want to invest your premiums. Your premiums can go into a fixed account or to an indexed account you select that is offered by the contract. Again, how does the annuity earn interest? Fixed or variable? So variable. Variable annuities offer the chance to earn greater returns. So returns, the profit on your investment. So they offer the chance to earn greater returns than the typical fixed annuity, but also they have greater risk and they require more active involvement by the contract holder. So active involvement means you may have to make decisions on a regular basis about your investment, and often those decisions need to be made annually. These annuities are highly dependent on the performance of the stock market, and they generally make no guarantees about earning. If the annuity fund performs poorly, you could lose some or all of your original investment. So, for example, if you own a variable annuity, in 1 year, you could choose to put 40% of the total value of the annuities into the annuity bond fund. You could put 40% into the stock mutual fund and maybe 20% into a money market account. Meanwhile, another purchaser of the exact same annuity could allocate his or her accumulated value in a completely different way. So thinking about the pie chart, you're putting the investments in the way that you choose. You choose how you want to invest your premiums with a variable annuity. You select the funds based on your own risk tolerance. And this means investors who purchase the same annuity will have different rates of return depending upon the decisions that you've made about how you invest your premiums. Again, it is so important that you discuss with your financial advisor. So, how do you pay premiums into the annuity fund? Single premium annuities are contracts where you pay the entire premium upfront in one lump sum. An advantage of a single premium annuity is that the full amount of your premium begins earning interest from day one. Flexible premium annuities allow you to pay however much you want, when you want, within certain limits. Most flexible premiums will require certain minimum premium payments, at least in the early years. In some cases, companies may also place a cap on the maximum amount you can contribute. This is the accumulation period, the period of time when contributions are being made to the annuity and the value of the annuity account is building. So, annuitization and withdrawals. This is an FYI. Annuitization is the process of converting your annuity into a series of periodic payments. When the contract owner is ready to begin receiving payments, the insurer computes a payment based on several factors. So, the value of the contract, the projected longevity of the beneficiary, so that means how long they're expected to live, and the type of payout chosen. Each annuitized payment includes part of the principal, while the rest is made up of earnings. A lump sum withdrawal is generally allowed, but it can be a costly move. You need to review your plan's rules, and you may be required to pay taxes, penalties, and a surrender charge. And we're going to cover this in a bit more depth in a few more slides. So, when does the annuity start paying you? Immediate annuities begin the payout phase within a very short period of time, so typically 1 to 13 months. For this reason, immediate annuities are typically paid for in a single premium, since the entire premium amount must accumulate before the payout phase begins. The purpose of an immediate annuity typically is to convert a large sum of cash into a steady stream of income for an extended period of time. Deferred annuities, they begin the payout phase sometime after purchase, and the time when the payout begins is dependent on the contract. The majority of annuities sold today are deferred annuities. Instead of receiving a payout, you also have the option of rolling the amount over into another annuity or to extend your existing annuity. Most deferred annuities include an accumulation period, which we discussed previously, the period of time when contributions are being made to the annuity and the value of the annuity account is building. So how does the annuity pay you? Several different options. It may be life only. The company makes payments for as long as the recipient lives. Payment amount is largely determined by life expectancy. The longer the recipient can be expected to live, the smaller the payment amount will be. There is no guarantee that the total amount invested will be returned. On the other hand, the recipient is guaranteed income for the remainder of his or her lifetime. If the recipient lives a long time, more than the amount paid into the annuity could be received. The next one, fixed period. The recipient receives a payment for a number of years, a fixed number of years. Payments after the recipient's death may be made to a designated beneficiary. Life with period certain. In this case, payments are made during the lifetime of the recipient with a guaranteed minimum payment. That means if the recipient dies without receiving the minimum payment, a balance is paid to the named beneficiary. Joint and survivor life. In this case, the company pays the annuitant or survivor for as long as either is alive. So not all annuities offer these options, and some may offer other options. Be sure to read the actual annuity contract in addition to any brochures the insurance producer may give you to learn about the features of the annuity and how the payout is structured. So what administrative fees and charges does the annuity have? And is there a surrender fee? It's important to ask your financial advisor questions about what happens to your annuity if you die or decide to purchase another annuity. If you're considering replacing one annuity for another, carefully compare your old product with the new one and ask the questions. Are the death benefits the same? What about the surrender value? Is there a surrender charge to get out of the old annuity? Are the annual fees and new surrender charges higher for the new product? And will there be a new surrender charge period for the new product or the new annuity? Most annuities will charge you a substantial penalty for a withdrawal from your accumulated value during the surrender period. So this penalty is called a surrender charge. It's typically the highest in the early years of the annuity, and it may be reduced or even eliminated over time. And so surrender charges commonly range from 5 to 15% of the amount withdrawn. High surrender charges can erase any earnings you may have gained. These penalties are the primary reason an annuity generally is preferred as a long-term investment, and therefore it may be unsuitable for individuals who may have immediate needs to access their funds. Please discuss the tax consequences of early withdrawal with a tax advisor. And also ask your financial advisor if the annuity contract includes a death benefit and a surrender value, and make sure you clearly understand the taxes you may pay on any benefits received. Some shopping tips. As I've said a couple other times, consider consulting an accountant, a financial advisor, or a trusted family member or friend. If you purchase an annuity that you don't fully understand, you could be in store for surprises down the road. So make sure that you talk to somebody that can help you understand the product before you make a decision. Shop around. Compare the guaranteed interest rate, the fees, the surrender charges of multiple annuity contracts. Also, compare an annuity's projected return with other types of investments. Even with an annuity's tax advantage, other investments may provide an equal or better return while providing less restrictive access to your money. Make sure the time frame for payout is right for your needs. So remember that annuities are not short-term investments. They frequently take at least several years to become profitable. Income in an annuity is not taxed until it is paid out. So talk to a tax advisor before buying an annuity within a retirement plan, such as a 401k or an IRA. Know how much risk you are willing to take on. So understand your own level of risk that you are comfortable with. It's important to decide the level of risk that you are willing to accept before you purchase an annuity. Weigh that risk, weigh that against the risk that is posed by the type of annuity that you're considering. So fixed annuities guarantee a minimum rate of return. Variable annuities have the potential to earn significantly more, but remember, you could also lose money. Verify that the producer and the insurer are licensed. So insurance producers and insurers must have a Maryland license to legally sell annuities in Maryland. In addition, insurance producers who sell variable annuities must have a federal securities license. Although it won't avoid every potential problem, verifying the insurance producer or insurer's license is a good first step toward ensuring that an annuity is legitimate and that it meets Maryland's state requirements. You can verify that by calling us at the Maryland Insurance Administration at 410-468-2000 or 1-800-492-6116. Consider the insurer's financial condition. Annuities are a long-term investment. So a company that's in solid financial shape is more likely to be around when it's time for you to collect on this investment. And you can learn an insurer's financial rating from an independent rating organization. Take your time. It's probably not a good idea to purchase an investment as complex as an annuity on your very first visit with the insurance producer. Take all the time that you need to make that decision. If you feel like you're being pressured to make a decision quickly, then you may really want to go elsewhere. It's a good idea to ask a trusted family member or friend to accompany you when you meet with the insurance producer if you're not comfortable with the information on your own. Maryland has a legally mandated free look period. So that means all annuities sold in Maryland come with a minimum 10-day free look period. So during this 10-day period, you can cancel the contract for any reason. If you have a fixed annuity and you cancel within the free look period, you may be entitled to a full refund. If you have a variable annuity, you may not receive a refund for any loss in the investment. Use this time to reread the contract and make sure that it meets your financial needs. If the annuity doesn't offer a free look period, be careful. If you have already purchased an annuity and it does not have a free look period, you may file a complaint with us with the Maryland Insurance Administration. And definitely be wary of annuities sold door to door or over the telephone. While most annuities sold door to door or over the telephone are legitimate, these sales techniques can lend themselves to fraud operations. If you do buy an annuity in this manner, obtain the insurer's physical address and make sure you have a way to contact the insurance producer or insurer. And we have some additional resources. On our website, we have a consumer's guide to annuities, and that link is here. We have information about the Maryland Life and Health Guarantee Corporation, as well as a consumer advisory trading your annuity for a new one. This is our contact information, the Maryland Insurance Administration. You can reach us at 1-800-492-6116 or 410-468-2000. And on the web, www.insurance.maryland.gov. Any questions, please do not hesitate to send me an email. That's patricia.dorn@maryland.gov. And the slides for this presentation will be available on our website as well. Thank you so much.